Hello guys, today we will talk about ROIC. ROIC is return on invested capital. You can find return on invested capital from many websites in the internet, but today we will see how to calculate ROIC from an annual report. The annual report we are going to use, that's the annual report of Vedant Fashion Limited. Vedant Fashion Limited is an Indian listed company, and we will see how to calculate ROIC from the annual report. We will calculate the NOPAT and we will calculate the invested capital. Yeah, the ROIC will not be the same that you will find on the other websites on the internet, because there are assumptions, there are different kind of interpretation of various line item from the annual report, and I'll explain what are the interpretation of my calculated invested capital and my NOPAT. So let's go. To calculate ROIC, we need two amount: invested capital and NOPAT. Invested capital, as you can see, there are adjusted current asset minus non-interest bearing current liabilities equal to net working capital. In that net working capital, we will add net property, plant and equipment plus acquired intangible plus goodwill plus other assets which we consider as invested capital. Then we will get the invested capital, and for NOPAT it's very simple: EBIT multiplied by 1 minus tax rate, that is EBIT. So first we will calculate net working capital. To calculate net working capital, we need current assets and current liabilities. So current assets and current liabilities. From current assets, we will not take all the current assets minus current liabilities. We'll adjust few items from current assets and current liabilities. Then we will, that's why I provided the formula as adjusted current asset and non-interest bearing current liabilities. So we will take inventories, we will take trade receivable, we will take cash and cash equivalent, we will take other current asset from the current asset, and from current liabilities we will take trade payables, we will take other current liabilities, provisions, current tax liabilities. So these items we are going to take. So first let's just calculate adjusted current assets. So adjusted current asset begins with inventories plus trade receivables plus other current assets plus cash 5%. So why 5% cash? Businesses need cash to operate. This is the simple thing. But for established business, big businesses, they do not need so much money to operate, because they have a goodwill in the market, and they can operate with lower cash, because they'll get supplies from supplier in credit for a long term, and they can sell the same for a and collect cash in a very short term. So they do not need to cash to operate. But this is a company, but when you dealing with a very high growth company, you need cash. So this is a very high growth company, Vedant Fashion Limited, and it's creating the market. It's not very established and big company in the market. So we'll take cash of 5%. And if the company is established and very big and have goodwill in the market, we just need 2% of the cash. So we'll calculate 5% of the cash. So we took three items from the current asset: inventories, trade receivable, other current asset. Now we are going to take cash, 5% of cash. So cash, and the total cash is for 2023 is 100.06 million rupees, and we'll take 5% of it. 5% of the cash is 5.003 million rupees. So there is, if we add all adjusted current assets, so our total adjusted current asset for 2023 is 6938.843 million rupees. Now we will deduct non-interest bearing current liabilities from adjusted current assets. So the first item is trade payables, other current liabilities, and provisions, current tax liabilities. Now the net working capital, we will deduct non-interest bearing current liabilities, and we will get net working capital. So the net working capital for 2023 is 4314.703. Now, if you pay a little bit attention to the current assets, there is a line item called investment. We did not include it in adjusted current asset. investment you can see 6176.85 million rupees, and compared to the total current asset it is almost 50% of the current asset. So if you take total current asset, it will be very very misleading, because 50% of the money is in the investments. It's not in the business. It's not operating, it's not generating any cash from operations. So if you add this item to invested capital, it will be very very misleading. That's why we are excluding the financial assets. Now you will see I have taken the trade receivable for financial asset. Trade receivable is an operating asset. That's why. And cash equivalent, as I said, 5%. So that's why I excluded the investments. And in the current liabilities you will see lease liability. I also excluded lease liability and other financial liability. In current asset also other financial asset, in current liability other financial asset, because these items are investing and financing items. That's why I excluded it. If you calculate the invested capital from financing approach, then you have to add these items and do other adjustment. But now we are calculating from an operating perspective. That's why we are excluding those items. Now let's calculate invested capital. To calculate invested capital, we have balance sheet, non-current assets. In non-current assets, property, plant and equipment, right of use asset, capital work in progress, goodwill, other intangible asset under development. These are operating assets. Okay. And the downline, deferred tax asset, non-current asset, other non-current assets. These three items in the down, deferred tax asset, non-current tax asset, other non-current asset, you can exclude this, you can include this. Some sources says that these are the operating assets, some sources says that these are not operating asset, but I think it's okay. And it's nice to add these items, because your invested capital, if your invested capital increase a little bit, because the item is not too much, 8282 is the total current assets, and from those current asset around 600 800, let's say 800 is these three items. If you combine these three items, it will get 800. So it's not very big, it will not make a very big change. Now I excluded financial assets, investments and others. There's the same region, financial assets are not operating assets. Okay. So adjusted non-current assets, property, plant and equipment, right of use asset, capital work in progress, goodwill, other intangible asset, other intangible asset under development, deferred tax asset, non-current tax asset, other non-current asset, and the total adjusted non-current asset is 5958.61. Net working capital is 4314.703 for 2023. Now if we add both of these, we will get invested capital 10273.313. If you see, the net working capital is almost not almost, but very close, not very close, but yeah, uh, 5958.61, let's say it's 6014.703. So very high net working capital. If you remember, the net working capital is high because of high accounts receivable. Okay. So it's important from a financial analysis point of view, but it's okay. I just added that information. Now calculate NOPAT and ROIC. To calculate NOPAT, we'll need EBIT. To calculate EBIT, there is a statement of profit and loss. From profit and loss, we need revenue from operation, and we need cost of material consumed, purchase of stock, changes in inventories, employee benefit expense, depreciation and amortization, other expenses. So now let's see to the adjusted P&L. First, revenue from operation. Now, cost of material consumed, purchase of stock and trade, changes in inventories, finished goods and stock and trade, employees benefit expense, and depreciation and amortization expense and other expense. If we adjust all of these, we'll get EBIT. So for 2023 our EBIT is 5670.62, and we need tax rate to calculate NOPAT. So how do we calculate tax rate? So tax rate is calculated by total tax expense divided by profit before tax. So profit before tax, tax expense, if we divide total tax expense by profit before tax, we'll get 25.5% of tax for 2023 and 25.6% of tax for 2022. Now 1 minus tax rate, it's 74.5% for 2023. Now we get the NOPAT of 424.62 for 2023. We bring the invested capital, divide NOPAT divided by invested capital, we get what? ROIC. So there is the ROIC of 2023, which is 41.12. Now there are analysts who will say that ROIC, to calculate ROIC we have to take invested capital, average invested capital, which is appropriate, but I did not take it. You can do it because the ratio is a P&L statement divided by balance sheet statement. So when we divide a P&L statement with balance sheet statement, we take average amount of the balance sheet statement, any ratio. So let's say return on asset, ROA. So in the denominator we take average asset. So and ROE, any asset, ROCE also we take average. So if you take average invested capital, it's also okay, but I wanted to calculate 2023 and 2022. That's why I did not take invested capital, because I have not calculated the invested capital of 2021. That's why. And that's it, guys. uh, Thank you for watching, and if you like the content, like, subscribe, and press the bell icon if you like it, and it will be very appreciable.